Now speaking, Börje Ekholm, President and Chief Executive Officer. Good morning, everyone. Thank you for joining us for this second quarter report. Despite challenging market conditions, we were able to deliver a solid quarter. We are executing on our strategy to build a stronger and more profitable Ericsson for the long term, which is focused on three priorities: bolstering our leadership in mobile networks, growing our enterprise business, and driving a cultural transformation of the company. We are a leader in the mobile networks market, with about half of the world's 5G traffic outside of China carried through our radios. We are expanding into the fast-growing enterprise market, using our expertise in advanced cellular networks to increase our addressable market and diversify our portfolio. We are also developing new ways to monetize 5G's unique features, like speed and latency, which operators and enterprises are showing great interest in. We are continuing our relentless focus on enhancing our compliance program. In the quarter, we saw India continue its strong development and network rollout, and we now have the leading market share in India as well. Our overall sales declined by 9%, but the decline in networks was partially offset by organic growth in cloud software and services and a 20% organic growth in enterprises. The EBITDA margin, excluding restructuring charges, was 5.7%. We are on track to reach at least break-even for the full year in cloud software and services. We saw a positive EBITDA in global communications platform, and sales from Vonage's current communications API offerings grew by 19%. We secured another important 5G licensing agreement with a device vendor that puts us well on track to further strengthening our IPR revenue base into 2024. We are intensifying our efforts on cost-out initiatives and are well on track to reduce our annual run rate by at least 11 billion, which will start to positively impact the P&L over the coming quarters. This overall performance is a testament to the underlying strength and resilience of our business and our ability to adapt and execute in a challenging macro environment. Now speaking, Carl Mellander, Chief Financial Officer. Thank you for the opportunity to present our quarterly earnings. Our results this quarter were in line with our expectations and guidance. We saw rapid 5G rollout in India, resulting in a 71% organic growth in our Southeast Asia, Oceania, and India market area. In North America, network sales declined 42% year-over-year due to lower CapEx spend and customer inventory reductions, but cloud software and services grew 10%. In Europe and Latin America, we saw a 6% decline in Europe and 3% growth in Latin America, mainly driven by additional 5G deployments in Brazil. This resulted in a 3% decline for the market area as a whole. Our reported sales in the quarter were 64.4 billion Swedish krona, a 9% decline organically. Gross margin, excluding restructuring, declined by 390 basis points year-over-year to 38.3%, primarily due to the lower sales and lower gross margin in networks, combined with large rollout projects. Cloud software and services gross margin, excluding restructuring, was 33.9%, a slight increase of 40 basis points year-over-year. Enterprise gross margin, excluding restructuring, decreased to 46.3% from 52.8% due to the consolidation of Vonage into Ericsson. Group EBITDA margin, excluding restructuring, was 5.7%, a year-over-year decline impacted by lower gross income from networks and increased investments in enterprise and the consolidation of Vonage. Cash flow from operating activities decreased to 2.9 billion, mainly due to lower EBIT and increase in working capital, driven by the business mix shift and large rollout projects. Free cash flow before M&A was negative 5 billion Swedish krona, and rolling four-quarter basis free cash flow was 6.4 billion, which corresponds to 2.3% of net sales. For Q3, we expect gross margin for networks to be in the range of 38% to 40%, OPEX to decrease seasonally, cost reduction activities to start to have an effect, cloud software and services EBITDA to be in line with Q2, and group EBITDA margin, excluding restructuring, to be in line with or slightly better than Q2. Now speaking, Börje Ekholm, President and Chief Executive Officer. In this quarter's earnings call, Ericsson reported that 5G subscriptions are expected to reach 1.5 billion by the end of 2023 and 4.6 billion by 2028. The company also noted that data traffic in the network continues to grow, and new use cases such as fixed wireless access and enterprise use cases are emerging. Ericsson is confident that the market will recover, with a gradual recovery towards late 2023 and improvement in 2024. The company remains focused on reaching the lower end of the 15 to 18% EBITDA margin target in 2024. Finally, Ericsson is focused on driving technology leadership in mobile networks, leveraging capabilities from cellular networks into the enterprise space, and strengthening its culture. Société Générale analyst Alexander Peterk inquired, "What is the disconnect between your 2024 EBITDA margin guidance of 15% and the consensus of 11.5%, and how do you plan to bridge the gap?" Börje Ekholm replied, "Our fundamental premise for 2024 is a recovery in the market, and we are confident that will happen. We have an ambitious cost-out target of 11 billion, and we expect to reach it. We also anticipate growth in IPR revenues and a strong turnaround in our cloud software and services. We are making portfolio adjustments to provide additional support, and we are aiming to be at the lower end of the range. Société Générale analyst Alexander Peter inquired, "Can you tell us which markets are weaker than expected and why? Is the US primarily affected, or are there other markets that are seeing a longer slump?" Bourier Ekholm replied, "We see a softer market overall since the end of last year, with network quality deteriorating in many markets. This provides the basis for investments, but the exact timing of customer purchases is difficult to predict. With our current visibility, we believe it's realistic to plan for that to happen later in 2023, which is slightly later than previously expected. We spoke about the slower build-out pace and inventory adjustments our customers are making last year, and these will provide support for market recovery toward the end of the year." UBS analyst François Bouvignies inquired, "Bourier, what is the current status of inventory correction versus a normal level at your customers?" Carl Melander replied, "François, in Q1 and Q2 we saw inventory reductions as anticipated. This trend will continue to some extent in Q3, but we anticipate it flattening out towards the end of the year. This should support a stronger second half of the year than the first." UBS analyst François Bouvignies inquired, "What is your plan for upgrading 75% of base stations outside China to mid-band, especially in the current microenvironment?" Bourier Ekholm replied, "We see 5G as a gradual build-out, with fixed wireless access playing a big role in the rollout. We believe that network APIs will be critical to monetizing the new use cases that 5G will enable, such as generative AI and XR. Goldman Sachs analyst Alex Duval inquired, "What are the main factors driving gradual market recovery this year and improvements next year? Do you have any further insights on the expected decline in other markets that are a bit farther behind the US in 5G adoption?" Carl Melander replied, "Alexander, Bourier discussed the key drivers for the recovery. We're seeing data traffic growth remain high in North America and other markets, which requires investments in the network to deliver the customer experience. 5G is the most cost-effective way to deliver gigabytes. Additionally, investments in modern technology to reduce energy bills and new applications like XR/VR devices will drive high demands on the network. All these fundamentals will drive the long-term recovery of the market." Bourier Ekholm replied, "Yes, Alexander. The long-term drivers of our business are the need for increased capacity and improved customer service. We are seeing customers build up inventory to manage uncertain supply chains, which has led to inventory adjustments that are working their way through the system. Once these adjustments have run their course, we expect to see a return to the fundamental drivers of demand for capital expenditure. This will be driven by the need for increased capacity and better customer service, as users expect a better experience than what they currently receive." Goldman Sachs analyst Alex Duval inquired, "What factors give you confidence that Q4 margins will be seasonally strong despite weaker RAN markets globally and in North America?" Carl Melander replied, "Alex, we typically see an improvement in the fourth quarter due to seasonality and inventory adjustments. Customer spending patterns and how projects are concluded also contribute to the stronger performance." Danske Bank analyst Andreas Joelsen inquired, "Peter, could you explain the reception you've received from customers regarding your enterprise strategy, particularly in the US? What is the pipeline looking like and can we expect the current growth to continue in the coming quarters?" Bourier Ekholm replied, "Enterprise wireless solutions continue to show good growth, despite tougher market conditions due to the economy. We have a strong pipeline of products and are building up our go-to-market organization, but we need to ensure that sales are paced with costs. Dedicated networks outside of China are still in the early stages, with only 1,000 to 1,500 deployed compared to 6,000 in China. Our platform business is showing good traction, with communication APIs growing 19% in the second quarter, though slower than in 2021 and 2022. We showcased the first network APIs at Mobile World Congress with 3 operators in Spain, and are continuing dialogue with leading operators to establish the network API market. We believe this is the way network resources will be consumed in the future, and are excited about driving the adoption of network APIs." Danske Bank analyst Andreas Joelsen inquired, "What benefit are Chinese enterprises seeing in dedicated networks that other countries are not, and how can you help them realize it?" Bourier Ekholm replied, "Peter, great question. 5G technology is revolutionizing the way businesses operate in China, with new use cases such as digital twins and inline inspection. These applications are providing reliable, always available, and secure connectivity, resulting in faster cycle times, higher quality levels, and increased manufacturing efficiency. We're also seeing these applications being deployed outside of China, but China is ahead of the curve in terms of new use cases." ABG Sundal Collier analyst Peter Kurt Nielsen inquired, "When will we start to see the underlying gross margins in India improve and contribute to a better overall gross margin, irrespective of the mix changes? What is the underlying run rate in IPR revenues now, adjusted for the one-off payment in Q2?" Carl Melander replied, our IPR expectation for the third quarter is between $2.5 billion and $2.8 billion. We anticipate substantial growth of our IPR portfolio next year, reaching $12 to $13 billion, thanks to new contracts. Bourier-Ekholm replied, Peter, the shift in our sales mix from 35% share of North America to 25% in India from 3% to 16% has resulted in a strengthening of our gross margin profile. We are executing well according to our plans and are pleased with the results. Citi analyst Andrew Gardner inquired, when do you need to see firm orders from customers in order to have a reasonable recovery in the fourth quarter? Bourier-Ekholm replied, historically, when we've seen these types of market situations, it's been a very short lead time for customers to upgrade their networks. It depends on the specific network situation for the customer, which is why it's hard to give a specific answer. However, from the customer discussions we're having now, we can see that many customers are starting to experience deteriorating network performance, leading to churn. We're confident that this will result in an increase in demand for our services, although it's difficult to predict exactly when. As a matter of fact, that's why we never discuss backlog in our industry, as the delivery cycle for capacity contracts is relatively short. Handelsbanken Capital Markets analyst Daniel Gerberg inquired, Peter, would it be fair to assume that the market recovery in North America will come earlier for some of your peers than for you? Is this due to more of your operations being concentrated in urban areas? Bourier-Ekholm replied, I think it's safe to say that we anticipated the market situation in North America and took the necessary cost-saving measures. We also believe there is a need for network capacity and modern equipment to address energy and CO2 challenges. Our assessment is that we will see a recovery in the second half of the year, which is in line with our historic experience. As for our competitors, I'm not sure of their business mix or situation, so I'll let them speak for themselves. Handelsbanken Capital Markets analyst Daniel Gerberg inquired, could you provide an update on the progress of the Open Gateway initiative and its revenue models? Bourier-Ekholm replied, yes, we are continuing to engage deeply with a number of leading customers around the world. We are working hard to create an abstraction layer in the network that will enable CPaaS to access functionalities from the network. We anticipate having a network API available by the end of the year, though it may slip into early next year. We will provide more details on this towards the end of the year. JP Morgan Chase & Company analyst Sandeep Deshpande inquired, Bourier, what gives you confidence that the telcos will densify their 5G cells going forward? Do you have any conversations with them that provide assurance? Bourier-Ekholm replied, yes, Sandeep, I'm confident that the need for reliable, always available connectivity will drive network traffic and create a market for our services. We are seeing an increasing amount of discussions on the network quality and the need for network quality, which gives me comfort that we will see a recovery in the near future. This is especially true as more and more applications, such as enterprise applications and AI use cases, require connectivity. We are currently in a phase of uncertainty, but at the end of the day, the end user will need a certain service, and that's what will create the market. We need to put more capacity in stadiums, shopping malls, office buildings, etc. to digitalize society, digitalize enterprises, and further digitalize the consumer. JP Morgan Chase & Company analyst Sandeep Deshpande inquired, what actions have been taken to restructure the software and services business, and what more needs to be done in the second half of the year to reach your goals? Carl Melander replied, Sandeep, we have taken steps to improve our profitability. We have exited from some subscale businesses and are automating service delivery to reduce costs. We have also implemented commercial discipline to ensure our new contracts are well scoped and priced. We remain committed to reaching break-even in 2023 and anticipate improved profitability in 2024 as a result of these actions.